I trade for just 30 seconds a day, not hours and not even minutes, just a few seconds. And you might be asking yourself how that's even possible, but it's actually very simple. The only reason trading could take hours is because of uncertainty. You don't know exactly what you're looking for, so you kind of have to sit on the fence and see what the market offers. But when you know exactly what you're looking for, you don't need to do any of that. If the market doesn't look exactly like you want it to look, you don't pay attention to it at all. The trade is basically already made before you take it. You wait for the market to come to you, fit your exact criteria, and then you execute and let it run. So in this video, I'm going to show you exactly how to trade in just seconds on ES futures every day. Now, once you get the hang of it, ES futures are pretty simple and routine. We have a pre-market session that opens up at 6 p.m. Eastern the night before. Then we open at 9:30 a.m. The market will typically be less active during this time period with more chop and less tradable moves. Then at the open, we get a surge of volume, since that's when all the stocks open officially and everyone can begin trading. So in the first few minutes, we almost always get a burst of volatility where the price is going to move rapidly. Then the market will typically settle and move in a certain direction to either the supply level above or the demand level below. If you're new here, I'll link some videos right now that'll show you exactly how to get this whole system set up. But simply put, the price will move from one supply and demand level to the next. That's how the entire market operates. We will usually get at least one or two of these moves per session, and sometimes we may get as many as 5 or 10 on more volatile days. And your job here is to nail just one of these moves correctly. You don't need to do some complex pre-market analysis or draw 10 different things on your chart. The framework of the levels is already laid out, so 90% of the work is done before you even begin, and all you need to do is go through a 30-second process to figure out if one of these level-to-level moves is worth taking. Now all it takes is 3 steps that you can repeat every single day. Let's start with step 1, which is to determine what phase of the market we're in, as well as the cloud's distance from the price. This is going to take up most of our process, because the market can look different every day, but it always falls into one of 3 categories. That's either going to be an uptrend, which is characterized by higher lows and higher highs, or a downtrend, characterized by lower highs and lower lows. Both of these will be very clear and obvious. You can identify an uptrend or a downtrend in just a few seconds. If it takes more than a few seconds, then it's not an uptrend or a downtrend. That's the third category, which is a range or a consolidation. This is everything that's not an uptrend or a downtrend. So if we look at the chart here, for example, what do we see? Well, we have a distinct high over here, and we also have a distinct low right here. And the price has been ranging in between these 2 points. That means we're currently in a range. If the price were to break above this high, then form a higher low, and then continue, we'd be in an uptrend. And same thing if we broke out to the downside. Now, determining the market phase in the first few seconds is extremely important because it's going to tell us exactly what we should be looking for. In an uptrend, we're only focused on looking for continuation higher with a break of supply. We have the scenario of a potential reversal in mind, of course. But what's going to happen most of the time is a continuation or a failed continuation in just a range. In a downtrend, we'd only be focusing on continuation lower. And if we're in a range, we're looking at both a break to the upside or a break to the downside, since both have a roughly equal probability of happening. So that's what we need to identify in the first few seconds, because that'll give us our bias for the day. Now the second part of this is the distance from the cloud, because if we're in an uptrend, it doesn't automatically mean we go long. Uptrends can sustain for a while, but they can also get overextended and later parabolic. Same with downtrends. And overextended or parabolic moves are not moves that we want to be in, because they have a very high chance of collapsing and taking us with them. So the way we measure whether an uptrend is healthy or whether it's overextended and parabolic is how far away it is from the cloud, specifically higher time frame clouds like the 1 hour. Because if we're overstretched on the 1 hour, then we're definitely overstretched on the 5 minute. So if the price is 3 or 4 or 5 levels away from the cloud, then we need to be careful because it's probably not going to sustain itself for much longer. If the cloud is following the price closely at a regular pace, then it's much more sustainable. And this really only applies to when the market is in an uptrend or a downtrend, since when the market is ranging, the cloud is pretty much flat anyway. So that's step 1. In a few seconds, you need to identify what phase of the market we're in. If we're trending, see how far we are from the cloud. If we're close, then we have a strong bias in the direction of the trend and should be looking for trades in that direction. If we're far, we shouldn't really be looking to trade at all, at least for now. And if we're ranging, look for a break toward either side. And that leads us right to step 2, which is to set alerts. So now that you've determined the market phase and decided if it's worth trading or not, you'll want to set alerts for a breakout. The only types of trades we take are breakouts. And what that means here is simply breaking out to the next level instead of returning to the level that we came from. So in this case, a breakout to the upside and downside would be a break of the upper supply level or the lower demand level. That means we'd set our alerts around the outer edge of both the upper and lower level. If that breaks, then we can confirm that the price will probably continue breaking out in that direction. If it doesn't break, then we're still trapped in this range, and we definitely don't want to be trading that. And in the case of a strong uptrend or downtrend, we'd still set alerts at both the upper and lower level as usual, but we're really only focusing on one outcome with the trend. So here the market is already open, and we just need to wait a few 5-minute candles before we can engage. We don't want to even look at the market for the first few minutes. Then we see that the market has a very sharp drop from this opening level and drops into the lower demand level. Now here our alert would get triggered and we'd open our chart. Because remember, we set alerts to not look at our chart. So we would determine the direction and cloud distance in a few seconds, then set our alerts based on that, and turn off our screen right after. We don't want to be looking at the market at all until we absolutely need to get involved, so that our minds are fresh before we enter. But once our alert gets hit, we can open our chart again and see what's going on. From here we move on to step 3, which is to execute our breakout trade. So now that we've had this very strong rejection here, the price seems to be breaking this demand level with a lot of momentum. What's most likely to happen here is that we continue breaking lower and hit the next demand level instead of moving back to the supply level above. So we enter short, target the next level, and place our stop above market structure. We can enter pretty much right away most of the time since our alert will be placed toward the edge of the level. So we'll have plenty of confirmation and less of a chance of the price going back into the range, compared to if it just touched the level. I mean, look at this candle right here. We dropped with a sharp impulsive candle and entered the level. But if we entered as soon as it touched the level, then we would have gotten stopped out pretty much immediately. This is what happens when you try to enter too early and without enough confirmation. So we want to wait until this price is deep enough into the level before we consider entering. But once that happens, we want to enter and not hesitate. And the short ends up playing out cleanly. That's one successful level-to-level trade that plays out in a few minutes, and now you're done for the day. So the 30-second strategy is simple. First, we determine what phase of the market we're in and how far the price is from the cloud. This takes a few seconds. Then we set our alerts and then shut off our screens until our alerts get hit. Then finally, we execute the breakout trade in the direction of our bias. And by the way, if you want help implementing this every single day on ES Futures, I work with traders one-on-one inside my accelerator program. You'll get one-on-one coaching, weekly group calls, access to my custom level indicator, and a private community of traders all running the same system. If you're interested, the link is below, and I'll be seeing you in the next video.